because absorption costing has this difference in inventory costs, right? You can defer fixed overhead. It might be difficult to set prices if we are only using absorption costing. So absorption cost information is useful because it reflects the full cost of sales and must exceed for the company to be profitable. Over the long run, though, price must be high enough to cover all costs. And so we're saying here that absorption costing has some difficulties, right, from looking at a monthly perspective, but it also is beneficial that it shows that at the end of the day, fixed overhead theoretically should be a part of inventory, right? That it's useful to apply it to a month for internal reporting purposes. But at the end of the day, the whole point of a business is to make money. And so if we want to see the true cost of a good, we should be able to allocate a portion of our manufacturing, our warehouse, and our salaries and all of that to our fixed overhead, to our goods that we're selling in order to determine the true profit margin. And so both sets of books are important. So there could be a whole class on setting prices. You can have a job. I mean, almost every large company has jobs called pricing analysts or executives of pricing. You could be a VP of pricing for pretty much any company. Or directing of pricing. It's that complex when you have multiple products. So I'm not going to go into a lot of detail here. Just here's the basics of setting prices. There's two major concepts behind setting prices. One is you always need to set a price so you're making a profit, right? That's one business concept. But then there's strategic pricing as well. That's the other world of thought where like Costco has loss leader products where you might go to Costco and buy a hot dog for $1.50 or a chicken or a pizza for $10 or a whole chicken for $5. They're making losses on those products, but in exchange, they're making higher margins on other products. And so there's these pricing strategies that are much more complex than what we're talking about here. Here, we're just talking about how do we make sure that we're not taking a loss on an individual product. So we're going to determine the product cost per the absorption costing, and then we'll determine a markup we want to make per unit, and then add the markup to the product cost. This is a very accounting way to do things. It's probably not the best from a pricing strategy standpoint, right? So just know how to do this. If you know, hey, I want to make a 10% markup, then we can figure out this calculation. But from a true pricing strategy standpoint, you need to look at competition. There's a lot more there, which you'll learn in future business classes. So we're going to use absorption costing to determine a target selling price. Absorption cost per unit is, we've determined it's $25. This will be given to you. And then the total markup price is 60%. So we're saying we want to make up a markup of 60%. That'll be given to you if this is a quiz. In real life, we'd probably want to determine what a fair markup is. You're looking at competitors or whatnot. And then under absorption costing is $20, $25. So then we just take our calculator, 25 times 0.6, it's 15. So we know our target selling price is 40. So we make our profit per unit of $15. So that's it. Just know that calculation, that what I could ask you, what is our target selling price per unit if our markup percentage is 60% and our absorption cost price is 25. Again, just that's another algebraic formula. So that's one side of a manager's job, is you can go into pricing. The other side is controlling costs. So there's the idea of controllable costs and uncontrollable costs. A controllable cost is what managers need to focus on. This could be any kind of variable cost. So it could be the costs of supplies, the cost of materials, the cost of your rent, maybe negotiable, right? Anything that you could actually negotiate, but there's some uncontrollable costs. So that would be, maybe we can't buy a new warehouse, right? We just don't have the money for it. Maybe we can't negotiate pricing in our market. Maybe we can't, their example here is maybe we can't control the production capacity. We can't increase the production capacity of our warehouse. So there's some things we can control and some things that are uncontrollable. We can't control the cost of electricity. Maybe we control the amount of electricity we're using and not the cost of electricity. That's set by the electric company. So just know that we focus on what we can control, just like in real life, right? Maybe you can't control the cost of your insurance. You get the lowest insurance price you can for your car, and that's that. You're gonna have to have insurance. But you can control how much you eat out. Same thing with managers, just on a much higher level. Like you can't control how, and eventually you can't control how much if you have very talented employees, how much you pay them. You need to pay what the market pays them. But you can control what their travel and entertainment is. You can control what kind of food you're giving them at your company. Same thing, you can do variable costing for service firms. So this is just kind of an appendix. I've talked about that a lot. So it just focuses on managerial decisions, and you can use this kind of overhead methodology and treat your employees that are generating you revenue as you can allocate them costs theoretically as well and figure out contribution margin and whatnot. I've done that example multiple times when I talk about firms or just using employees in general. So don't need to go into that in detail. And then there's this concept of using variable pricing for special orders. So the concept here that I just want you all to get is that when we have a special order, the concept of a special order is like a rush job. Like imagine that you're a company, you produce mugs, but then Apple calls you and you just produce standard mugs that maybe say like, Mom, I love you, or something, some of those cheesy mugs you can buy on Amazon that are cute. Let's say Apple calls up that mug company and says, hey, I want 100,000 Apple branded mugs in next month. You have to determine, okay, well, can I, and we'll pay you $5 extra, but you're gonna have to determine the cost benefit analysis on, well, is that $5 extra worth adding the branding to? Is it worth stopping our regular production? Can we produce more? And so the concept here is the price must be high enough to cover all costs, including the variable costs and fixed costs, and still provide an acceptable return to the owners. And we're also gonna have to determine if it's okay enough to make up for our lost production of other products. And so over the short run, fixed production capacity, such as the cost to maintain the plant capacity. If we have excess capacity, can we increase production? If not, are we gonna have to add more costs? And they're gonna have to try to maintain their existing orders and cover those existing costs. So the idea is that if there's a special order, you're gonna have to make sure that it doesn't increase your long-term costs. From a service perspective, you have to think of, like in consulting and accounting, there's a lot of risk of having very busy times during tax season, or if a company goes public and you have to do some kind of filing. And if you're paying hourly employees, a company comes up to you and says, hey, we want to go public, or hey, we have a huge tax filing and we need 500 hours of someone's time for the next 2 months. You have to determine, well, am I going to lose my other clients? If I'm paying these employees hourly, is it going to cost me more than it's worth to win the project? And you're going to have to price the project accordingly. I'm not going to do any questions on the quiz related to this pricing of special orders, but I'll just go over it. So the idea here is, should the company accept a special order for 1,000 pairs of skate at an offer price of $22 per pair? The special order maybe has a special branding or something. And so we'll have to do this cost benefit analysis. So if we reject the special order, we get no incremental income. But if we accept it, we have $22,000 in incremental sales. We have $15,000 in incremental production costs and $2,000 in variable selling and administrative expenses. So we'll make $5,000 to accept the special order. And that would only be the case if we are also not losing other sales, like we're not losing our other production. So this is the case if we have excess production. If we had to sacrifice other sales, potentially this wouldn't be the case. And so we're saying here, our direct material cost, all of our variable costs per unit exceed, the price exceeds the variable cost per unit. And so what we're going to be using here, and why contribution margin is so important, is generally for contribution margin is positive, we would accept the special order if we can say that our variable costs will be less than our selling price. And that's another reason why contribution margin is important, right? Like that extra order is just going to go towards our fixed costs, but we just have to be careful that we're not losing out on our original sales as well. If it costs us more than we can sell it for, then obviously we shouldn't produce it. But we're only looking at variable costs here because the fixed costs don't change. So that's really it from an absorption costing standpoint. In summary, I just want us to remember there's really two costing methods we're going over. We went over today with chapter 5 and chapter 6. We have variable costing, absorption costing. Variable costing, sales minus variable costs equal our contribution margin minus our fixed costs is our net income. This shows us pretty accurately the income in a given period, normally monthly. Absorption costing is GAAP accounting. Absorption costing includes fixed overhead into our inventory cost, which can relate in delays between months if we have an excess of production or an excess of sales in a given month related to inventory, because that fixed overhead is allocated to the inventory. But that's required for GAAP. And so if we expect these lags in sales between months, or we have a lot of fixed overhead, we should probably have an internal set of books in order to determine the profitability given by month. Otherwise, managers are incentivized to overproduce items, which ultimately leads to a long-term cost increase in inventory because of storage costs for inventory, even though managers are incentivized because it will look like they're making more money in a given month. And so having these two sets of books, allocating this information can be really helpful for making business decisions. And we learned that variable costing is also very helpful for break-even analysis, for determining target sales, making business decisions and business opportunities, and using that break-even analysis for business plans. So that's really the summary for everything today. I'll pause, open up for questions, and do office hours. Thank you very much. Let's see.